Officially, welcome to today's Zoom meeting, everybody. We have Ben, Sanchit, Jimmy, and Daniel joining me. My name is Lijo. All right. So yes, Daniel had a question. Let's begin with Daniel's question.
Yes, I've been noticed that lately the game is a little different. It's getting harder to get out of the rat race, uh, playing the big deals. So I'm not sure if something changed or if it is just me or if it is me being bad luck. So what happens? It's actually the market cards comes less often than usual. Then I get into bankrupt a lot of times, almost every time I play. And the market cards always come for small deals like 2B, 1B, gold. I believe something changed, and it is because of this context we are living, but I'm not sure. I just want to share with you this and ask what you think and if you are experienced the same. Not sure.
Uh, to be honest, I have also noticed that the game is getting a little tougher uh, to handle through the big deals. I'm not sure whether it is because I've noticed this many times before that if we are playing on a lesser number of players, like say four players or more, 4, 5, 6 players, normally I've seen that the market cards come more often. But during the if you play only 2 player, if you play just 3 players, it doesn't always pop up. The big deals market card doesn't always pop up. That is from the past. But recently I have also noticed that the big deals don't come up, the market cards for the big deals, like if you have a Plex unit, it doesn't come up very often. If you have if you have an apartment, it doesn't come up
Yeah.
very often. So this is, I have in fact noticed that. And if they have made it difficult, then it is good for us.
Yeah.
This is what I say, because if they have made it difficult, that means we learn more. We are now, you have noticed this, that the big deals cards don't come up very often. So, good. If we have to renew our strategy, if we have to rethink our strategy, if we have to, because right now in the world, a lot of things are being redefined. The way we do business is changing, and there is a lot of things that we have to rework, that we have to reconsider. Like for example, I've been following a lot of these shows like Dragon's Den or Shark Tank, or now recently The Profit. So a lot of things have been happening. Oh, that reminds me, I haven't checked with Patrick. I haven't heard from him in a long time. So I've been following these shows, and these shows are all about people who've got a lot of money, people who have made it successful, people who are financially free, trying to make new investments. So people, it's basically let's say it basically looks like a lot of players in the fast track. And what these people have been doing, and this is what I've noticed, they have been investing in failing small businesses. They have been investing in businesses which are cash crunched. They have been investing in businesses which are finding it difficult, especially after the pandemic or through the pandemic, through the 2016 17 financial crisis. So uh, they are changing their focus from the big business, not that they are abandoning it, but they are changing their focus of investments from big business projects into multiple small businesses. So the way the big guys, the way the players in the fast track today around us in the real world, the way they are doing business, the way they are investing is changing. And we are seeing a lot of these changes. And we have to think, where are we? What are we doing? Is our strategy, is everything that we learned still applicable in the same way we thought in the past? So probably whatever we learned, like I believe the most of the people who have written about financial freedom or financial independence, like Robert Kiyosaki, and so these are all. I've got one of his books right here. No, I've got, in fact, two of these. I was referring to them. I've got the cash flow quadrant, and I've got the increase your financial IQ, which I was looking through, because last time, I think last meeting, I promised that I would look up the stakeholders of a business, the definition, Kiyosaki's definition of who are the stakeholders of a business. I still haven't got around to do that, but I will do that very soon. I've actually taken the steps. So what I was trying to say is, we have to we have to rethink. Okay, these books, whatever they have written, whatever these big guys have written, I have also been reading about reading "Screw It, Let's Do It" by Richard Branson. So everything, all of these people, they primarily talk about, the most important one single thing that they focus about is education, and the next thing that they focus about is attitude. It is the mental framework, it is how we think, what we are focusing our energies on, where we are putting our what is our intention, how are we focused on our goals, and what are we doing, or how are we making an effort to uh, mentally prepare ourselves to bring about that maturity, to make sure that we are able to handle the way we behave, the way we communicate, the way we accept the changes, or the fast the dynamics that happen around us. So the most important thing here is not whether our strategy is correct, or whether our plans are on track. The first thing that is important is whether our education is right. The next thing that is important is whether and by education, I mean what we are trying to do in this meeting, like analyze, is this a good deal? Does it actually fit into my portfolio? Is it actually going to help me get out of the fast track with my target income of, let's say, 600K or 700K or 1 million or whatever it may be? But is it going to help me? So everything is connected. And this is, in fact, strangely, this is one of those things that I was thinking, that it is high time, after so many meetings, we should cover this. It is about being focused on our vision, being focused on our goal. Oh yeah, I'll come to that in a while. But what I was saying is, first of all, education. And the education should lead us to think clearly, in a better, like an investor, like a businessman, like a business owner, uh, like someone who is eligible to go into the fast track. Now, most of the times, what happens is that we think going into the fast track is only about money. No, it is not. Going into the fast track is about uh, attitude. It is about the personal, mental, spiritual growth that we achieve apart from the IQ that we build up. So Kiyosaki, in fact, increase your financial IQ. In this book, he talks about emotional IQ. He talks about financial IQ. He talks about 5 different kinds of IQs. And let me read that out to you. It is a really interesting thing. The 5 different IQs that he talks about. Let's say, all right, the first the okay, this is about, oh, this is the 5 financial IQs that he's talking about. But in another portion, let me see, I don't know if I can figure that out, but he talks about what is financial intelligence, what is financial IQ. All right, okay, never mind. I'm not going to spend too much time there. But the point is, there are different kinds of IQs. There's an emotional IQ. There's an academic IQ that we are saying. There is financial IQ that Robert Kiyosaki talks about. So all these kind of IQs have to come together before we can actually get into the fast track. Or when we are in the fast track, we are expected to have that kind of maturity. And that is why most people who come into quick money are not able to uh, keep it, because one of the financial IQs that Kiyosaki talks about is how the IQ about how to protect your money, how to protect your investment, how to make sure that you can actually, if you start making money or if you come to money, you can actually hold on to that money, make sure that that money is not wasted, that money is not lost, or that money is not squandered, the money is not nobody actually cheats you to, or you are not mismanaging your money, how to protect your money. So this is one of the things that Kiyosaki talks about. So if there is a change in the game, uh, if there is a modification of strategy that we need to do, then it's perfectly all right, because the world around us is changing, and we have to observe what the people in the fast track are doing today and try and learn, because that is part of our education. When we learn how to observe and how to understand what they are doing, that is when we can actually be confident that the changes that we are making in our strategy, and I believe you are making changes in your strategy. So if we are making changes in our strategy, it is this is the only way to right now be sure, because when we make our investment, or when we take that step, we need to have this financial IQ, or we need to grow this financial IQ of how to make this money, how to protect our money, how to leverage our money, how to leverage on the other factors of business that we come across. So, all these happening, we have to consider how the world around us is changing, how the businesses around us are changing, how they are adapting. And when we are coming into that uh, concept of how to uh, prepare our new strategy, that actually helps if we have the observation and the learnings from the game. If the game has changed, very good, I love it. And if we have to change, if we have to think more and evolve another strategy, very good, let's do it together. All right. So I think the game might have changed, but if the game has changed, I think the world around us has changed, and we are just on the right track.
Yeah, I'm trying a new approach for that, so I will let you know if it work or not.
Okay. Having said that, in the last few days, all the games that I've played, it has become more difficult, but it is the same strategy that I've used. The same strategy has always got me out into the fast track with what I wanted to achieve. Now, this is again, okay, let's talk a little bit about that as well, because um, one of the things that the game should teach us is that there are 6 players in the game, and of the 6 players, not everybody is going to make the same deals, and not everybody is going to get into the fast track or achieve their goals. Now, getting into the fast track is the first goal that we have. When we open our financial statement, the first thing it says is, right on top it says, increase your passive income and escape the rat race. Now, I've said this before, and I've mentioned this many times on the club, on the chat, but I will say this again. The goal of the game is to increase your passive income and escape the rat race. It does not say beat everybody else. It does not say come first. It does not say make this kind of money before you go into the fast track. It doesn't give you anything more. It just gives you a one-line goal which says increase your passive income and escape the rat race. And this sentence, I believe this is one of the beautiful sentences. This is one of the beautiful taglines or goals which should teach us several things. The first thing is that the idea is to get better, increase your passive income. So it's a goal which is it is a goal which is defined with positive words, all positive words. So it says increase your passive income. So that is the first goal, increase your passive income. So it says that is why you are playing in the rat race. And have you noticed the financial statement changes when you move from the rat race to the fast track? In the fast track, the financial statement doesn't say increase your passive income. It says something else. So let's talk about what happens in the rat race, because honestly, in my opinion, I believe if you move from the rat race to the fast track, you have already achieved your primary goal. So if you are moving from if you are increasing your passive income, that means you are actually making the right investments. You are investing in cash flow. You are investing in uh, assets which are actually putting money, and that is the primary thing. Uh, the whole concept that Kiyosaki talks about throughout his book. I know many people have only read the Rich Dad Poor Dad. They have not moved ahead and read any other books in the series, or any other books sideways, horizontally or vertically. They have not moved, because reading is a challenge for many people. I think that's the whole business model that Audible is based on. Okay, I'm not advertising Audible, but I know a lot of people over here actually use Audible. Fine. So even in the book Rich Dad Poor Dad, he says an asset is something that puts money into your pocket. Now, again, if you wanted to analyze the definition of an asset, he does not say an asset is something that continuously puts money into your pocket. It doesn't say every day it puts money into your pocket, or at regular intervals, every payday it puts money into your pocket. It doesn't say that. He says an asset is something that puts money into your pocket. Now, that could be in capital gains, And that could be in cash flow. It could be either ways. So there are two ways of an asset putting money into your pocket. The first one is through capital gains. So you buy something, and you buy something in profit. Now, this is a concept that we regularly use while playing the game in our strategy. So I think we have already mentioned this many times before, but I will still say it because Jimmy is with us, and I believe he has not been through any of our previous videos. So an asset, sorry, what were we talking about? Buying in profit. Yes. So an asset can have valuation. It can have a cost and it can have a valuation. Now, if I have, let's say, a mobile phone with me, there is a cost of building, or there is a cost of making this mobile phone. But there is also a value of the mobile phone. That is why you find the same functions done by the same phones but sold at done by similar phones but sold at different costs, different pricings. Now, there is a value associated with an asset, with a product, and that value is primarily in the mind of the consumer, is primarily in the mind of the person who picks up that asset, who buys that asset. So the buyer has to offer a valuation. So the buyer is considering that, oh, if I buy this product, this is going to be worth so much to me. So that is a valuation. Now, the price, the cost comes from the seller, because the seller thinks the cost of making this product, of building this phone, of building my house, building my asset is so much. Now, there is a cost and there is a value. The cost comes from the seller, the value comes from the buyer. Now, if the seller is able to understand, if the seller is able to identify, and this is what a good salesman does, if the seller is able to identify exactly what is the value that the buyer is willing to pay, what is the maximum value that the buyer is willing to pay, then the seller can put a price. So there is a cost and then there is a price. This is the asking price. Now, you can set an asking price which is close, which is sometimes very near the valuation that the buyer is willing to uh, ascertain, or the buyer is willing to offer. So if I am willing to buy this phone for let's say $600, if I'm willing to buy the phone for $600, and the is seller understands that yes, there is this guy who is willing to buy this phone at $600, he can sell it to me for $599 and I will be very happy as a buyer. But as a businessman, as someone who is into someone who is looking for an investment, now I don't know if you have noticed Jeremy on our Cashflow Club. Jeremy has been trading with earbuds, the earphones. Now, when Jeremy is trading with those, he buys very low, which means he is buying close to the cost of the product, and he sells at a price which is higher or close to the valuation of his audience, of his customers. He is sold off all the stock that he has picked up, and I believe he is going in for more. So wish him all the luck. Wish him a good thought process, a sensible activity on his e-commerce website. But when you have a price, and you are able to say, oh, this is closer to the cost, so I am in profit as a buyer. This is the way we can analyze whether we are buying in profit or not. Now, buying in profit has uh, many requirements. The first thing is that if you want to buy in profit, you should know what is the cost. You should either know what is the cost, or you should know what is the lowest valuation that the seller is willing to offer. Now, there is a cost. The seller has to price the asset at a price higher than the cost, because otherwise he will not be in profit. He will not make a profit. And the lowest valuation that he offers will be the closest to the cost. If as a buyer, if I as a buyer, I am able to understand what is the lowest valuation the seller is willing to offer me, and as a buyer, if I know what is the highest valuation that this particular asset has in the market. These are two things that we need to know when we are getting into a deal. What is the lowest valuation for this particular asset that the seller, or anyway in the market, what is the lowest valuation that this asset may have? What is the highest valuation that this asset may have in the market? Why? Because as a buyer, I will be buying in profit only if I go to the lowest valuation or close to the lowest valuation. So it is very important for me to know what is the lowest valuation. On the other hand, if I want to make a profit, I need to know what is the highest valuation that I am going to be able to get once this asset is with me, once this asset is my responsibility to make money out of. Because if it doesn't make money, it is not an asset anymore, it becomes a liability. Now, this is the reason why Kiyosaki says your house that you live in is your liability, not your asset, because you will keep spending money on your house and it will not put any money in your pocket. All right. So, this is about buying in profit. So Kiyosaki says, Rich Dad tells him, if you do not buy in profit, then you cannot make a profit when you're selling it. And this is one of the things that we learn from the game also, I mean, from the deals in the game. And this is very, very true in real life as well. So it is not surprising that it was included in the game in the way it was. All right. So this is about assets. This is about buying assets in profit. So there are assets that we pick up, and the asset has to put in two kinds of money into our pocket. Or the asset an asset is something that is capable of putting two kinds of money into our pocket. One is through capital gains. So capital gains, it's a trade deal. You buy in profit, you sell in profit, and the difference between your selling price and your buying price becomes your capital gains. And your capital gains are your money. It comes as cash one time. So every capital gain comes only one time. The second kind of income that your asset brings you is cash flow. Now, if you are looking for the second kind of income, that is what increases your passive income, because cash flow from an asset is something that comes to you because the asset belongs to you, not because you're working for the asset. Now, a job, okay, let's say I come from the S quadrant. I'm not employed. I am self employed, or I am a small businessman. So I'm not coming from the E quadrant. Now, I'm sure everybody is aware of E, S, B, and I, cash flow quadrant from Robert Kiyosaki. So I was in the E quadrant when I started out with earning money, and then I moved to the S quadrant. Now my intention is to go to the B quadrant, and then eventually move to the I quadrant. So when you are in the E quadrant, your only asset is your education. You have spent a lot of money for your education. You have spent a lot of money for your, you have invested a lot of money. You have taken a lot of expense for your education. And then your education allows you to trade your time for money. So you have education, which is of some value. You have time, which is of some value. And then you have the mental health or the mental stability which an organization requires. And you put all of these three together and you offer it to a company. And the company takes your time, the company takes your education, the company takes your mental stability, puts it all into a system. Now then you become part of a system. It puts you into the system. It puts everything that you have, or everything that is of value, into the system, and the company trades. The organization trades your time along with a lot of other people's time, trades your time and makes money. So makes a profit. Now, if the company has to, remember this, if the company has to make a profit, they have to first buy in profit. If they are buying in profit, what are they buying? It's not just the raw materials that go into their product. They are also buying your time. They are also buying my time. So when they buy my time, they have to buy my time in profit for them, which means they have to buy close to the cost. They have to buy close to my cost of maintaining my skills, of developing my skills, of acquiring my skills. Now, I have acquired these skills at a cost, and then I say, okay, this is the cost that I want, or this is the valuation that I put to my cost of acquiring these skills, or acquiring this knowledge, or acquiring this education, keeping my sanity, and being able to work with so many other people in the organization. So the company is buying in profit, so which means can't be too good for me, huh? But a lot of people are happy with that, because it gives them what the company offers them in return, or a job offers them in return, is security. So people like you and me, we go to a job, we say, I will give you my time. I will give you my education. I will give you the results of my education. I will give you the result of my experience. I will give you the result of my mental sanity, of my mental stability, and my soft skills, and my attitude and my behavior. I will give you all of these. Instead, give me money. Give me money just enough. This is I don't know. I think this is part of one of the books in Kiyosaki, from Kiyosaki. Says the companies pay their employees just enough so they don't quit. I don't know where I read this. I can't really, seriously, I can't place this. But the company pays the employee just enough to keep them in the job, just enough so they don't quit.
Yeah, I remember that. Also reading that.
Yes. Okay. So Jimmy, sorry, this is I've been talking a lot. I've been continuously speaking. We haven't yet gone into the game, but I think this is important for us to. This is one of the important things for us to consider, which is why I keep on going on this. So normally this is about the time that we have to go into the to go into the game, but I want to today. In fact, I've been thinking that we should talk about our goals, and this is one of the reasons why I'm taking this time to uh, connect all these dots together. So that's about an employee. When it comes to a small businessman or a self-employed person like me, I love the fact that I can dictate, I can decide, I can be my own boss. I can decide if I want to work today, or really, can I? The fact is, I cannot. The fact is, today, if I get a client call, I have to attend to it and quit this meeting. So my client decides whether I should be working or not. My client decides whether I can actually. So my client is actually my boss, and my client dictates. Even though I have the illusion that I am in control. I'm really not in control, because if my client is not happy, then I'm really, I'm not so happy about being in control, because control didn't mean anything to me. Right. So what happens here? As an employee, you were part of a system. As a small businessman, I own the system. I am the system. So the quality of my product, the quality of my service, the quality of anything that generates revenue in my company will only be as good as how I define it. This is what happens when you become a small businessman, or when you become an S quadrant, when you become a specialist, when you become a small businessman, when you become self-employed, when you become a consultant, when you become independent, or in my favorite term is one-man show, because most self-employed people are one-man shows, or they are a small group of people who are led by one person, or two people, three people maybe, but a small group of people. This is the case with most of the people. I mean, 20 employees, 25 employees. It is where you are the system. So if you stop working, the system collapses. Now, if you were an employee, you were part of the system. So the system defined everything that you become. The system defined everything that you do. The system dictates on you. As a self-employed person, I dictate what My system does, because I am the system. And the moment I am taken out of the equation, the whole thing collapses, the whole thing stops working. Now, that is about uh, the S quadrant. Everything else is just the same as the employee quadrant, the E quadrant, because uh, you are still trading your time. Only thing is that you are trading your time for a better value. Now, as an employee, if you were earning $5 a week, sorry, $5 an hour, as a small businessman, you would probably make $15 an hour. But it is still limited to how much time do you have to trade. As an employee, you can trade up to, let's say, 16 hours a day. People sometimes they work two jobs. People work overtime in the same job. All of this is just trading their time. The same thing when it comes to an S quadrant, when it comes to a small businessman. Sometimes I spend the whole night at when I was the first business that I started was into IT infrastructure. So I was very much on the ground. So I had my staff and me. We were all together. We were just one team. There was no difference between employee and employer because everybody was working. All hands on the deck. That's what it was. And sometimes when we either when we are on a rush job or when we are behind schedule, what we do is we spend the entire night on site. We spend the entire night. We're continuously working. So is and sometimes we take. I've taken my mattress to my client's place, and I've slept on the floor over there. I've spend the night over there. I take short breaks. I take, as it is, I sleep only 3 hours or 3.5 hours most of the days. But what happens is when I want to take a nap, or when somebody else, one of my staff wants to take a nap, wants to take a break, spread out the mattress, take a quick nap, take turns. There's only one mattress, so everybody else has to be working at the same time while somebody is taking a nap. So this is how a small business owner or a small business survives. When you are the system, when you are a very small team, this is how it works. So again, you are trading time. Move on to a big business. I don't have experience with this, but I'm hoping to get there one day. So I've been thinking a lot and I've been planning a lot. So which is why I say this. Move on to a big business. You have a 500 or more people working for you. And when you have that kind of numbers working for you, you are trading, you are buying time in profit, and you are trading time for profit. So you are actually buying time from your employees. Remember the other guy, the employee, the E quadrant guy who is giving their time. So he is giving time to the business owner or the business entity. Now, when it comes to B, most of the time it is not a single business owner. Most of the time. Most of the time it is a board of directors. And now, remember who owns the system? The organization owns the system now. The board of directors owns the system. What happened over there? My microphone must have failed. I will keep it aside and I will use the right. So, did you miss much? Should I rewind a lot?
No, it was like 30 seconds maybe.
All right. Okay. All right. So we were talking about businesses, B quadrant businesses. B quadrant businesses, they own the business organization owns the system. Now, most of the time, if you have a B quadrant business, it is not a single owner, it is a board of directors. Now, a board of directors
and then a lot of employees below them, 500 or more employees below them. Now, everybody, the organization is buying time in profit from its employees. Now, remember the other guy, employee who is selling his time, who's trading his time for security and money. Now, these are the guys who work for these places. And the organization picks up time and uh, expertise in profit. Now, what happens if an employee stops working? His income stops. If a small businessman stops working, his system collapses. If a big, in a B quadrant business, if one person stops working, nothing happens. The ownership is to the organization. The system ownership is with the organization. If one person quits, he is immediately replaced by somebody of equal expertise or better expertise. Now, the funny thing about expertise is that it is like technology. Expertise, as it becomes older, it becomes cheaper. If you knew typing, if you were a stenographer, you would have a great value before they introduced computers into businesses. Or let's say in the 1990s or before, when they only had typewriters in most offices, or they had very crude by our definition today, where they had very low end computers those days. So a stenographer had a high value. Today, we just speak to our computers and the computer recognizes, the computer understands what we are trying to say, the computer types out what we are trying to say, the computer executes what we are trying to say. So technology has moved, so older technology has lesser value or zero value. This is about the expertise. If I knew typing, it wouldn't mean anything today. But if I knew typing in the 1990s and the 1985s, I would be highly regarded. I would be well qualified. This is the this is how expertise goes out of trend. This is how expertise, as it becomes older, it brings lesser value. The same thing happens with technology. As technology becomes older, it has lesser value or little value because new technology is being introduced. So this, Roger fell asleep and probably wants to join. Would be a good time to join. Let's see if he wants to come. Right. So that's about a B quadrant business. Let's see. He's coming in. All right. That's about a B quadrant business. So the ownership of the system belongs to the business, and the employee who is part of the system works under the system that is owned by a business organization. Now, investors, I will not go too much into the yes. So I will not go too much into the investment part of it because it's a it's relatively straightforward. You when you have the cash, now this is where it connects to the game. This is a hi Roger, welcome.
Hello, hello. So I'm sorry for the late. So sorry.
No problem. We were
There will be a fee. You'll have to pay a fee. next time.
I'm so sorry, guys.
No worries. When I post the video for this, you can catch up with what has been happening over here. Mostly, I've just been talking. I've been talking for too long now. But
Okay.
yeah, we haven't started the game yet, so you're just in time. You can when we start the game, you can just join us on that. All right. So this is still the first meeting, and all right. So we're talking about investors. Okay. So when you go back to the game in the rat race, an asset is something that generates cash for you, or generates uh, income for you, and that income can be in two ways: as capital gains or as cash flow. Some assets they actually give you both. Well and good, wonderful. You have to be sometimes very fortunate to not just fortunate. You are in the game. You have to be fortunate, but in real life, you have to be very carefully observant, very carefully watching your market, looking around, analyzing what is going on in your market, so that when the opportunity comes up, you can quickly pick it up. You can quickly own it. Right? You can make a deal very fast. So that's about. So okay, Roger, that just about sums up what we've been talking about so far. What an asset is, what kind of, how many different kinds of assets we have, or what kind of income we can get from the assets. Now, when you make capital gains from an asset, this is where you have to think like an investor. What am I going to do with this money? If I sold my asset in profit because I bought it in profit, now I can sell it in profit. And when I get an opportunity, I sell it and I make capital gains. Now that capital gains could be a few $1,000s to a million or more dollars. So like in the game, if I got a chance and I sold my 60 apartment complex, the best I would make is about 1.7 million in cash. So I can make that. Right. There's Sri Harsha, I believe. Sri, okay. All right, let us. Hi, Sri.
Hey, hi.
Hi, I think this is the first time you're joining us on this meeting.
Yeah, yeah. It's the first time I'm joining, but I'm joining from a little bit of hassle-free traffic. So I don't know if I can be so much very good audible to you guys or not, but I'll be keep listening to you guys.
Perfect.
Yeah.
The audio is perfect. Very good. We can't make out that you are in traffic, so no worries about that.
Fine, thank
Glad you
you.
could join us. I hope.
Your audio. Go ahead.
Yeah. Okay. So, Sri, we've just been talking.
Lijo.
Yes.
Are you able to pick up your microphone again, just in case, because it sounds much better with the mic.
Really, it does? Okay. I thought so. Let me try. Right. Let me change my microphone.
No, it's very bad.
What kind of mic is that? Can you fix it? Okay. Turn up your volume then. Or turn it off, I think. Yeah, there we go.
Let me see.
Oh well, there we go.
Okay. All right. Good. I will speak more into the camera because my camera has got my other microphone. So I will try and see. I will try and look the camera in the eye, and I will try and do this. All right. So, all right. So we were talking about assets, and we were talking about making capital gains on assets. Now, when you make capital gains on assets, now most people now Like say, for example, Jeremy. Jeremy is from our Cashflow club, and he has been doing a trade on earbuds, like we already mentioned before. Well done, Jeremy. Uh, so now Jeremy has made some capital gains on his trade. He has bought some earbuds in profit, and he has sold them for profit, and he has made some capital gains on that. Now he has two choices. One, he can think like an investor. Now this money is free cash. There is no liability that he has to pay off from this cash. He can think it two ways. He can think like an investor and decide that this free cash that I have is going to um, bring me more cash. So he can choose between using the cash to bring more cash.
But up here is the reception and where our office manager works. So she welcomes.
Sanjit, you were trying to say something? I couldn't hear
No,
you.
no, just am I audible?
Yes, you are okay. Somebody else was speaking,
Oh,
and
I mistakenly unmuted the microphone. Sorry.
all right, no problem. All right, cool. So Jeremy has two choices. One is he can use this free cash, his cash which he does not have to use to pay off any of the liabilities from or liabilities associated with his business. He can use this free cash and pay off some of his other liabilities, which means he is not going to use this to generate income. Instead, he is going to pay off some of his um, other expenses or liabilities. Or he can use this cash and invest it. So his cash is now his asset that he is investing to generate more cash. These are two choices that every one of us has when we make capital gains. We invest the cash or we spend the cash. Both ways, the cash goes out from our pocket. But one of the routes that the cash takes brings back more cash. One of the routes is a one-way traffic. It just goes, it doesn't come back. So it is our choice when we make capital gains, or let's say when we have surplus cash, to convert it into an asset, which is what an investor does. Or we can spend the cash, which is what someone from the E quadrant definitely does. Now, spending that cash can also happen in the form of savings. That's a funny part. So when an employee saves money in, I think we had this very interesting. You should go back. All of you guys should go back to the previous video that we made, the previous Zoom meeting that we had. Ersin was uh, Ersin was showing a spreadsheet, an Excel sheet, on how you lose money when you save. It was a beautiful explanation. He just had a mathematical model on how it is done. So you should definitely go back and watch that video and find out how that video and how he explains that. I don't want to take time in explaining that, but because he has done a very good job, and I just want to give him credit for that. And I want to just direct you over there so you can actually pick it up directly the way he expresses it. But the point is, an employee, when he gets cash, and instead of investing that cash, they do invest it, they do spend it rather. They spend it on different saving schemes like your 401k if you are in the US or you are in one of those countries which follows the 401k plan, but in other kinds of bonds and stocks and things like that. Well, not stocks, okay, stocks is a different thing. In bonds, in saving certificates, uh, so in those kind of things. So eventually the returns on this plus the inflation plus the locking up of your capital, all of these together, or just letting your money sit in the bank, uh, all of this is actually a way of spending off the value of your asset, your cash. You are reducing the value of your asset. You're reducing the value of your cash. Your cash is not appreciating. Your cash is actually depreciating. As time goes by, cash that is just accumulated is going to depreciate. So the best way is to invest it. And the best investment that you can do is first in your financial education, because without that investment, all other investments are wasted. Because without financial education, you have to depend on somebody who is financially educated or somebody who appears to be financially educated. This is what happens to most of the people from the E quadrant as well, because they depend on someone who appears to be financially educated, whereas the expert that they depend on could eventually be only investing their money in something that drops in value, something that depreciates, something that does not give you assured returns, or something that gives you less returns than you can achieve if you were financially educated and if you were doing it by yourself, or if you were able to at least discern, understand if the expert that you are consulting with is really an expert in growing your money or not. Right. So we went from strategy in the real life to assets, from assets to the the four quadrants. Then we went to how the people who are in different quadrants are are in different portions of the system, and how the investors, they actually use the asset, which is cash, to generate more cash to invest their money and multiply it. So the this is how capital gains work. Now, you the second part of the asset is cash flow. Now, some assets give you capital gains, some assets give you cash flow, some assets give you capital gains as well as cash flow. Now, what is cash flow? When your asset returns even a dollar or any portion of money after all the expenses associated with that asset, you call it a cash flow. Now, if you have a house and you have a mortgage on it and you are collecting rent on that, so your rent minus your mortgage minus your regular maintenance expenses, routine maintenance expenses, all done, finished, and then you have your what remains. What remains is your cash flow. Now, if you have a house, you pay a mortgage of $150 every month, and you collect a rent of $300 every month on your house. There, you have your $150 as your cash flow. Your $300 is not your cash flow. Your $150 is your cash flow, because it is what remains after all the expenses associated with that particular asset. Okay, now so we have a surplus of $150, which comes from cash flow. This comes every month. This is a recurring thing. So this every month, this keeps coming into our pocket. And if we are already covering everything with our other incomes, this 150 becomes a surplus. Now the question is, what do you want to do with 150? Do you want to invest it? Maybe 150 is too small to invest, because it comes, if you want to make an investment, probably you want to make something more substantial, which is bigger. You take your 150, and in the game, what it helps you do is it helps you leverage this 150 from with a source of with another source of cash. If you wanted to borrow and you have to pay 150, let's say if you borrow 15,000, or no, if you borrow 1,500, and you have to pay 10% every month as repayment, that means you already have a passive income of 150, cash flow of 150 coming in from one of your assets. You are taking it and you are putting it against your monthly repayment of 1,500 in cash. So which means not a bad thing, is it? Because you have made your 150 work for you. You have taken this 150 and you have converted it into 1,500 today, which means you can invest 1,500 today and start working on an asset which will generate probably more cash flow, and you will still be one step ahead. Ben, is that how it works in your short-term rentals?
That pretty much sums it up, yes.
Right. So this is one of the ways Ben is working. Ben is doing his courses on short-term rentals with Jay Massey, and he is working on that front a lot. He is working on building his portfolio with short-term rentals. So well done, Ben. Keep going. So that is about how an asset can generate cash flow, or how an asset can generate capital gains, and how we can use that. If you have cash today, yes, it's well and good. But if you have cash flow, it's not so bad, because you can use the cash flow to generate cash and invest. The bigger cash sum that you have received, leveraging your small cash flow to 10 times. And most of the time, that's not, I mean, today, most of the banks, or most of the money lenders, or let's say even your investors, if you look at investors in the fast track, this is where we began our conversation, like how I observe people who are already in the fast track in real life, and how we observe what kind of investments they make, and what they look at, when you present them with a business plan, when you present them with the financials of a business that you are operating. They look at you and say, oh, you are generating revenues of 1.5 million in a year through your business. But yes, your profit from it, your net profit is very small. Let's say only for the 1.5 million that you are doing in revenues, you are only creating 100,000, or let's say even 50,000 in net profit. Your net profit is low. But since you have your revenue, since you have your customer base, since you have an active process that is happening, we just have to look at your efficiencies. We just have to work on how we can bring about more profitability into the business. So here's something that is happening in real life today. Here's something that is happening when people look at your business, when people look at what you've been working on, what you've been building, and they say, all right, this is a good start. Now let's make it a great finish. This is where most of the people in the fast track right now, today, in real life, are doing things. This is how they're taking it. The reason being that they want to diversify, they want to protect their money, they want to protect their uh, cash flow. They want to protect the way they generate money. They want to protect the way they hold money. They want to protect their investments. And this is how they do that. They invest today, they are investing prolifically in many small businesses. When they invest in many small businesses, the advantage that they get is that they have diversified, they are they are well diversified, and they are protected for any situation, any bad situation, or any uh, disaster that happens, economic disasters that happen, like a pandemic hitting. Nobody can predict a pandemic hitting unless you actually planned it. But there are some theories about that as well. But that's not a controversy that we want to get into. But the point is, if you do not know, sometimes you know, sometimes you know that there's trouble, like a war, for example. A war, you know, for a certain time in advance that okay, there is tension over here, there's going to be trouble over here, and there might be a war, and so you need to make some you need to take some steps to protect your investments. But things like a pandemic, things like earthquakes, natural disasters, other natural disasters like a tsunami, can't be predicted. And the one way to protect your investment is to protect your money, to protect your income, is to diversify your investments into many small entities. That is happening today. That is my observation today. It does not mean that the large investments are not happening, but a lot of activity, a lot of traction happening, a lot of things moving in the small business sector, in the investments into small businesses. The reason being that the investors are not actually experts in running that particular business, that particular small business. They have no intention of staying in that business, inside that business, and taking over the operations. They have every intention of making it more efficient, using the guys who have actually started the business, or actually have run the business for a while, making them more efficient, teaching them to be more independent in their and um, smart in their decision making process, and generating cash, generating profits for both of them. That is what an investor does. Now, in this game, I've tried my best to explain how the game, the financial statement, the the deals in the game, how they actually connect to what I know of the real market scenarios, the real market situations, that and what I have observed from what is happening in this period during and after and through the pandemic. So, Daniel, I think that was a very long explanation. I think, hey, the meeting didn't end. Did they take off the time limit on this? They did.
Yeah.
It's about, let's say, we lost, we restarted the meeting at 15 minutes. So that's about 8:15 GMT that we started the new meeting, and now it is 9:35. So it went on for more than 40 minutes. So I think the thing is not, there's no time limit on this, which is good. Nice, I'm enjoying this. I just hope that I made sense. I connected with what I connected the dots well for you to. If you want to know, if you want to contradict me, if you want me to change anything, I mean, if you think differently, you could please tell me, because that's the only way I learn.
No, actually, great insights on your talk.
Thank you, Daniel. I hope I have answered your question on how the game changing, in my opinion, is good. I mean, if the game has indeed changed, I don't know if they changed the code for the game, but if they have changed the game, I would be quite happy.
The game has not changed at all. It's just sometimes it just happens like that. So
that could be because I've only noticed this recently, because a couple of games that I was in, it was so difficult to get the big deals market cards. And so, I mean, it has happened to me before, but then not on 2 or 3 games at a stretch. So it was like,
Yeah. What is happening to me is that it comes the market cap for the 12 units or 24 units in the beginning of the game, and that kind of business actually can make you kill your debt, right? But at some point, if you don't get that kind of deal or that kind of market card, you will be increasing your debt always and always. And when you have the market card for the units, that amount of money is not enough to kill your debt, because you are for so long in the in the rat race.
yeah.
So I'm trying to not get into that and try to establish a limit for my debt, like 10,000 or 20,000. I'm not sure yet, but I'm keep trying to find the sweet spot for the debt. In the past, I would bother with that. I just, when a good deal shows up, I would buy it. But now I'm thinking carefully, because I don't know if in the future I will have the potential to sell it, and even if I sell it, I will make profit, but I will still be in debt, and I won't be able to get out of the rat race. This is what is happening right now. But it's as you said, it's changing, and it leads us to rethink our strategies, and yeah, that's it.
Right. Welcome, Titus. Glad to have you around.
Thank you. Thank you.
Right. So we have 2 new members in our Zoom meeting today, Jimmy and Titus. Good, good. It's really exciting to see the kind of interest that you're taking into financial education. Only that we have spent about an hour and a half already over here. We already covered quite a bit, so we will be posting this video on YouTube, on our YouTube channel very soon. As soon as I can get, as soon as we finish the meeting and I can get it edited and ready. So once that is there, you could definitely go in and see what you missed out, catch up with everything that actually happened. But now let us move to the game, shall we? Not much time.
Yeah.
I think We have about 20 minutes. I think since the Zoom meeting is going on forever, I think we will take the extra 15 minutes also. Right. So I'm creating a game. It will be called Cashflow, and we have 1, 2, 3, 4, 5, 6, 7 people now. Let's say, all right. I will not. Okay.
I can stay on the side.
Before you last, huh? Good. Good. Okay. I'm going to create a game with a password this time, since we only have a little time and I don't want to spend too much time waiting for somebody to get out. So you can see the game cash flow. The password is just number 1, single digit, number 1. All right, I see Roger, Jake. Okay, that's okay, all right. I see Titus, Daniel. All right, excellent. Good. All right, and let me share the screen. The screen, there you go. All right, cool. So, quick cap on what it is. So I'm a nurse. My starting salary is okay. Let me switch off this audio. My starting salary is 3,100. Now this is about what we just spoke about. The employer pays you just about enough so you don't quit your job. So that's 3,100. You have 480 in savings. The starting cash is 480. That means, and when you look at the payday, that's 1,150. Now remember what we just discussed. If you have 1,150 in recurring income, which means a recurring surplus, you want to take that money and you want to invest that, but you want to multiply that money and make it something big enough for you to make use it for investment. So that means in the game, at least you can make it 10 times. So that means I have 11,500 to invest. So I am as good as 11,100 to invest. So that's what I understand from when I look at my payday. Now, what is most important in the game? Okay, let's look at the financial statement. It says increase passive income to escape the rat race. Remember, this is where we started our discussion. This is one of the goals of the one. I think next meeting next week, if I'm around, we will also take up the topic of discussing personal goals. Uh, just like a company that has goals, company has a vision statement and a mission statement. Now these are not. Why I did not want to start off with the goals is because I also wanted to prepare something where um, we could look at different vision and mission statements from different corporates, different companies, and try to understand what the vision statement is and what the mission statement is, so that we can also eventually create our own vision and mission statement. This is very important in our direction forward when we actually are able to consider ourselves as a system that is in development. And one of the most important things to develop a system is to have a vision, because that defines the purpose of the system. Right. Let's go back to the financial statement. It says increase passive income to escape the rat race. It says payday of 1,150, which means I'm good for up to 11,500 in cash. No assets, and my total expenses are 1,950. So that 1,950 is my minimum passive income requirement. This is what it says. This is how the financial statement talks to me. It says my minimum total expenses, sorry, my minimum passive income that I require is 1,950. Now, something that I did not mention before and something that I would definitely like to mention is, notice that it does not say decrease your expenses and exit the rat race. It does not say, it only says increase your passive income to escape the rat race. It does not say decrease your expenses and increase your and let your passive income cover up the expenses to escape the rat race. It does not say decrease. And Kiyosaki, in all of his books, in all of his teachings, I don't think he has ever said reduce your expenses, because in his uh, teaching, in his books, what you realize is reducing your expenses means trying to live below your means. And he is not an advocate. He does not allow you in his teachings to think cheap, to live cheap, to reduce your expenses, to say it is unaffordable and I can only afford it if I cut spending on something else. No, that is not the concept of the rich dad thing. Uh, the concept is to increase, to grow, to invest and generate income so you can afford things which are not affordable right now. So even if you increase your expenses, it is fine, but it is not so great. It defeats the purpose of the game if you try to reduce your expenses. All right. So I choose a dream. I always choose the dream which I come to the last, so I can spend most of the time in the fast track. So I choose. So that's personally me. You can choose anything that you want. Now, am I ready to roll? I'm going to roll, and I get one of the big deals. Now look at this. Transferred skilled tradesmen kept this 3x2 house in excellent condition. So it commands top dollars rental in an older neighborhood. You can actually see the cash flow from the property, from the house, is $400. Now, this is where market research, we spoke about market research in the beginning of the meeting. Market research in the game, it is about how familiar we are with the cards, with the deals. So as you play more and more, and as you see more and more, as you open more and more deals, as you see more and more cards exposed, you will, you have to, you have to consider what is the cash flow that can happen from a particular kind of asset. What is the lowest cost that the buyer will ask for a particular kind of asset? What is the down payment that is uh, common in the marketplace? What is the down payment that I am expected to carry in cash? Because you are allowed to borrow your down payment in cash as well, but that is not going into your mortgage. It is going into a separate loan with your financier, with your source of cash, which is most probably your bank, or it could be money lenders, it could be friends and family, it could be any different kinds of sources which we have talked about before, but which probably we will talk at in one of the other meetings also in another occasion, but I will not go into that right now. But there are different sources of cash, but those cash borrowings, those loans that you take, do not go into your mortgage. So which means it does not affect your cash flow from the asset, but it definitely affects your personal cash flow, which is your personal payday. So if you take a loan, it goes out of your payday, it does not go out of the cash flow from the asset. So it actually helps us, it actually teaches us that an asset has to have its own balance sheet. An asset has to have its own financial statement, which we don't deal with in the game, but when in reality you have to. This is the way you analyze. This is the way you evaluate whether an asset is actually uh, generating cash flow or cash flow negative. The cash flow negative is a financial term. I am not very qualified to explain about cash flow negative, but we okay. Let's see. Somebody is trying to join this meeting. No, somebody is chatting. Okay. All right. Okay. Fine. So cash flow negative is one of the terms that we should learn because that is part of our analysis. I would gladly let you Google it because I myself have to Google it if I have to give a proper definition of that. But so you, it helps you if you consider, if you have to consider, if you are an organized, if you are an let's say if you are a systematic systematic person, you know that you can analyze every single asset based on the cash flow that it generates, the value of the asset in the current market. So you can look at the financial statement of one particular asset if you wanted to do that. And you have to do that in many cases to actually be able to make a decision on whether it is actually a valuable asset or not a valuable asset. And Daniel, I just realized one of the things, like say, if you get into your apartments early on in the game and then later on, if you find yourself running out of value, because if you are not able to sell it and cover up your debt, you also have to think that it could also be because you have not considered carefully what your portfolio is. Your portfolio should not just have one kind of asset. Sometimes it does happen. I mean,
Yeah,
last
yeah.
one of the
Yeah. Always try to diversify, but
diversify, yes, diversify
yeah,
your investments. You should have apartments, you should have flex, you should have some houses, even if sometimes they take your houses back from you and you are only left with the debt that you incurred, but not with the cash flow. So that can happen sometimes. So in all of these situations, what you do is you have to invest in businesses, you have to invest in flex units, you have to invest in apartments, you have to invest in houses, you have to and uh, I tried this before, but I'm not very sure of what I'm saying. But I did want to try a gameplay where when I've covered my passive income using uh, big deals, but I still have expenses. I want to move to the small deals and see if something happens. But I've never been very impressed with the capital gains I got over there or the cash flow that I got over there. So I don't think it is ever a worthwhile thing. Spending time or spending my role, spending my opportunities on rolling for small deals. Right. So you have to diversify and get into different kinds of assets. So your debt is not just based on one particular asset, is based on all the assets that you have. And you can, if you are, I would love to do this, but it's not always possible when we are playing with other players from across the world. But if we are able to track individually, one by one, when I purchased an asset and how many runs I do through paydays before I am able to sell it. Now, this is very arbitrary in the game because and in real life also. But the point is, this would give me a clear picture of whether my game is actually going in the right direction or not. But that's too complicated for now, because most of us, what we need to do is we need to figure out what the game means before we can actually go into one of those things. So I will not go into that discussion right now. Okay, so this looks like, uh, now everybody, if you've got your pen, paper and calculator, you could start doing this. The cost is 67,000, and the down payment is 12,000, which means it is a little less than 20%. I think it must be somewhere around 18% or something. I'm not doing the calculations, I'm just doing it mentally. So I think somebody, if you have already done your calculation, the older guys, somebody who is not here for, who has been here before. What percentage am I paying as down payment? 1, 2, 3, 4, 5. Only 5 of us over here.
Looks like a 17.9.
17.9. Okay, so that's about 18%. Ben, could you explain how you came to 17.9?
Okay. To find out the down payment cost in percentages, I divided the down payment with the costs and times 100. So 12 divided by 67K times 100. Then you'll find the calculation.
Excellent. So everybody, if you have got that correct?
Yes, one question about you. Which percentage could be to call like good good no good business?
I understand. So you want to know what is the maximum that you would want to pay in down payment,
That's correct.
right?
Yes.
Yes. What is the maximum that you would pay in down payment? Now, this is very specific to, in real life, this is very specific to the kind of market that you are dealing with. Okay. The reason why I say that is you have different asset classes. Like say, if you look at commercial property, you have, if you look at the real estate market around you, if you look at the kind of deals that you can look at, you will see residential locations, residential zones, and you have to identify these zones. I think if you played long enough on the game, you will also see some of the deals which says 10 acres of land, the forest-like land, which has got a stream in it and all of that. So that's from the small deals side. You will also see 20 acres of land in the big deals, and sometimes you will see the market cards for these. And in the market cards, you can actually observe, they will talk about the zone that the property is in. So they will say, okay, the zone is right now, it is in the zone is residential, and the buyer will rezone it into an industrial land or into a commercial land. When you change the zone of a property, you are actually creating additional value, or you are changing the values that are associated with the cost, that are associated with the cash flow, that are associated with the down payment. Now, if you are looking at in the game, in the game, I would say anything below 20% is a good deal as far as down payment goes. But that's not the only thing that we have to consider when you have to take a deal. But 20% down payment is kind of the maximum that I would go. In the game, there are deals which work for I think as low as 5% down payment. That's what I remember. I can't be very sure of that, but we can see that. I mean, the point is, when you look at a deal, you have to see the cost and you have to connect the cost with the lowest valuation that is possible for that particular kind of asset in the game or in real life also. So if you see a three-bedroom house in your locality and they are asking for the seller is asking for a particular cost, the particular price, you have to compare it with a trend. You have to look at it for the last 20 years, what has been the transaction value for this kind of property. How has the trend been going? Has the trend been going up? Is the trend coming down? Is it currently the lowest that I can get? Is it currently the highest that I could probably go to? So where is this? Is it closer to the cost or closer to the highest valuation? Is my valuation that I'm being offered today closer to the cost of the asset or closer to the highest valuation that I could possibly get for this asset? So this is how you look at the cost. You look at the down payment and saying, okay, if there have been deals in the past for this particular asset or a similar kind of asset in and around this area, what has been the down payment? Now, this in some countries, some markets, it is possible to find this information from your government offices, from your regulatory authorities. But in some places, it is very difficult to estimate because sometimes you don't see the real value of the asset on the document. Whereas it could be a cash transaction which is not recorded properly. So there could be a lot of uh, street value. No, this is how you define it. There could be street value and there's value on the document. Now, if there's value on the document, you are liable to pay taxes on your deal, on your transaction, which makes it a little unattractive for many people to show the entire transactional value on your property, on your document, which means they deal a lot of they make a it's not a fake document, but uh, it's an untrue document, which has got untrue information, and they do the transaction in cash, and so that generates a lot of untaxed income for somebody, and that untaxed income is not actually legal money because you are creating black money in that case. Anyway, so in some markets you can see from your records what the valuation of the trade is. So you can actually find the real trends that are happening in that market, whether the trend and the trends. There's one of the most recommended videos on how an economy works, which was posted by one of our. That reminds me, Shivam must have finished his exams. I don't know how they went. Shivam, one of our members, has actually posted one of the videos from YouTube, and I will surely post that link again on the club chat. So this video talks about how the economy works. It's a very interesting video, and how the trends are formed, and how you can inspect closely to understand if the trend is a short. You can see the short-term trend. You can see the long-term trend, and then you can understand whether the short term, whether you should play the deal in the short term trend or the long term trend. Okay, in the game we can't do that, but at least in the game we already have a lot of information about the market cards, and then we compare the market cards and we say, okay, now you found this in the, okay, let me give you my market information. In the big deals, you will find the cost of a 3 by 2 house at 65. 65 is the lowest that you can get. So if 65 is the lowest I can make a deal on, 67 is a good cost because it's just $2,000 extra in valuation. And I also know that the market card for this can sell this house at $135,000. So that is about 100% in capital gains. So if I bought this at 67,000 and only at a down payment of 12,000, which means only at a down payment of 18%. I make a down payment of 18% and I sell this at a capital gain of 100%. I make capital gains, and in the meanwhile, I am getting $400 in cash flow, which means my passive income is going up by $400, which means my payday is going from 1,150 to 1,550. Okay, so what I was good for earlier, 11,000 11,500. Now I am good for 15,500, right? Yes. I'm good for 15,500 in cash. Now, if I have 15,500, if I am eligible for 15,500 in cash, I can borrow against it. I can borrow 12,000 against it and make this down payment. Now, if I make that down payment, that means I can have an asset which is generating $400 in cash flow for me. I have an asset which has the potential of making 100% capital gains for me. If and I will have a payday of what will that be? 350, 1,500 minus 12,000. Okay, somewhere around that. Doesn't matter. We will figure out. But my payday will still be positive, which means I can still borrow money against my payday before I go to zero or before I go to negative. So I'm still good for some cash. I can own this asset which generates passive income of 400 for me, and I can at the best opportunity I can sell this property and make 100% capital gains, or maybe if I spend a few more days in a few more pay days before I can actually sell it. So my interest payment, so 1,200 in my down, which is against which is the repayment of my down payment, my loan for my down payment. It might take a few $1,000s out of my capital gains. So I may not get 100% return, but I will still get some kind of capital gains on this one. So I will just go ahead and buy this, and we will look at watch my financial statement carefully. So I'm taking a loan of 12,000 and I'm with a monthly payment of 1,200. I say yes. So that takes me down to a negative 50 in my payday, which means if I don't do the deal and I keep the loan, I will still have to pay $50 every payday from my cash. I will buy this and it will take me to 350 in my payday. So I have lost some income from my payday, but I have converted some of my salary income into a passive income, right? And I have generated the potential to keep some capital gains, uh, prepare for some capital gains. Right. And it is also important to look at where these figures have gone, because in the board game, like how Jesse mentioned in one of our in some of the chats that we had before, the in the board game you have to do this math by yourself, and you have to assign your figures into the financial statement by yourself. Now, if you look at it in your assets, you have a 3 by 2 house which is valued at a base of 67,000. In my liabilities, after my down payment of 12,000, I have a liability remaining of 55,000, which is being paid by the property itself, which is being paid by the 3 by 2 house. So my 55,000 liability is not my concern. It does not appear in my income statement, because it is not affecting my income statement, because the mortgage payment, the repayment of the mortgage is already calculated into my cash flow. So what I get is my $400 after all the mortgage payments have been made from the rent or from whatever income I'm generating from that asset. Right? We will look at this more often as we do more deals. So right now I will end my turn. I will, okay, somebody's chatting. Okay, okay. All right. Sure, okay. So any, Roger, we entered this game or you entered through another device. Right. Okay, I've been talking for too long and I want to ask if there are any questions. No questions. Okay, all right. So let's do a deal from Sanchit. Sanchit, can you
Yes.
share your screen? Let's have a
Yes.
look.
Is it visible?
Not yet. I think it's coming on. All right. Yes, you are a janitor. Wonderful. You know, the
Okay.
best thing about
So
being a janitor is look at your expenses, 950, and look at your payday, 600.
1,600 cash flow
Yes,
and 650 per day.
payday. Which means you can borrow how much before you go to zero?
It's around six. I should not cross 650. If I
You
cross it, then I will have negative cash flow.
okay. So your payday is equal to 10% of your cash, or the cash that you can borrow. 650 means you can borrow cash up to 6,500. All right. So that's a cap.
The,
That's
the,
your
the lowest profile. I have the lowest profile here in the game.
yes, yes, which is good because you can, if you have a low expense, it gives you a great control of deciding when you want to go into your fast track, how quickly you want to go into your fast track. But it is not possible if you think like an employee, if you think like a E quadrant person. Because in the E quadrant, you think of saving money from your payday, which is your 650. You accumulate money from your 650, which is your payday, and then you try to invest it. This is where the game has another message for us, which is the game is trying to tell us that it does not matter if you are a janitor, it does not matter if you have a very low salary profile, it does not matter if you are not doing something important as a job. You have the potential to go into the fast track regardless of what your salary is. Now, this can happen in real life, which we will talk about later or probably some other time. Right. So, have you chosen your dream? All right.
Roll.
Roll, yes.
Can I roll?
Roll,
Okay.
roll.
Big one, right?
Big one, yes. Just hold on a second. Just hold on a second.
Here it is.
Just hold on. I'm trying to get the game link for Roger.
2.5% is.
Copy and let me paste it out. Just give me a second. Just give me a second. All right. There you go. Roger, you have your link. Right. So, okay. Sanjit, you have been in this Zoom meeting long enough to be able to make your own analysis. Can you do it?
Yeah. So
All right. Let's hear it from you.
in this case, the apartment house is for sale and its cost is 5,75,000 and down payment is 75,000, which brings a positive cash flow of 3,400. And if you calculate how much is 3,400 out of 75,000, it brings like 4.5 percentage.
Right.
Is that correct?
Yes, that's a good that's a good way to. This is something that we missed out in discussing the last one. Good that
And
you
I have
brought it up,
one
Sanjit.
question.
Very well done. So
I have one question.
yes.
So in real life, what is the best percent of return of investment?
All right. Now this question is a good question. If you see this deal, it has a return on investment of 4.5%. Now, how did you get
Yes.
the 4.5%? Sachin, can you explain?
3,400 divided by 75,000 multiplied by 100.
All right. So you are actually calculating your return on investment on the cash flow that you are receiving from this asset against the cash that you are spending to acquire control of this asset. I hope this did not confuse you. 3,400 is the cash flow after all the expenses that the asset has. Now, there are two parties involved here. There is the asset. So the asset already has its own expenses. The asset already has its own income. So the asset has expenses, the asset has income, which is why we said earlier that the asset has a profit and loss statement. The asset has a financial statement. Now the asset has its own financial statement, and then we have a financial statement out of which we are paying 75,000 as down payment, which is our cash investment. So we generate cash through any means, any way, any source. It is our cash, and we take that cash and we put it in as the down payment for this particular asset, which has its own cash flow, which has its own financial statement. And we are going to see what cash flow is my cash going to generate. What is my cash getting in return? What is my return on investment on the cash that I'm investing, not on the whole asset? Many people make the mistake of looking at it from the whole asset point of view, which is not, which in my opinion is not the right thing to do. It is because I am only involved for 75,000 in this deal. I am not involved for 575,000. For the remaining 500,000, the bank is dealing directly with the asset. The lender is dealing directly, the mortgage holder is dealing directly with the asset. I am not involved in that and I have no say in that. So there is no reason for me to be involved with the 575,000. I only have to be involved with the 75,000, and how I generate that cash, whether it is through a loan, whether it is through friends and family, whether it is through my own capital gains, which I have made from my previous deals, it does not matter. But I have the 75,000, I invest the 75,000. What is my return on 75,000 is what I should be concerned about. All right. So 3,400 or 3,400 divided by 75,000 is the percentage into 100 is the percentage of return on investment that I'm getting. So I'm getting 4.5% return on investment for the 75,000 that I'm investing. Now, this is one of the calculations. This is one portion of it. Now the next portion of it, I have to be clear, am I doing this only for cash flow? If that is the case, I have to look at only my return on investment. The second question is, or am I doing this for capital gains? So if I am doing it for capital gains, then I need to figure out what is the cost that I am paying, what is the valuation that I'm paying against, and what is the valuation that I can command when I sell this asset. So remember, if you buy in profit, you sell in profit, and you create capital gains. Now, is there a possibility to create capital gains from this asset? This is the question. Now, this question can be answered how? Sanjit?
Yes.
How do you think you can answer the question of whether this asset is going to, whether I'm buying this asset in profit or not?
Yes, definitely it's for profit.
It's not profit? How can you say that?
Because we are having the positive cash flow of 3,400. And the capital gain is 575,000.
No, the capital gain is not 575,000. The capital gain is when you buy this asset, the cost that you pay when you buy this asset, the cost that it has when you buy this asset, from the cost that you have when you sell this asset. What is the difference? How much cash can you generate by selling this asset at a different valuation, at the highest valuation?
It means the value can rise up to 575,000.
No, it means the value today is 575,000.
And when it rises, what does it become?
What does it become? Do you know this? Do you know what it can rise to?
No, I don't know.
You don't know. Okay. So this is where market research, again, we are coming back to the same points that we started this discussion with. This is where market research comes into picture. You have to know from the data what is the lowest valuation of this particular asset, what is the highest valuation of this particular asset. Now, if you know the highest valuation, which you have to find out, and you have to find out through different means, and you have to find out through your market research. In real life, you have to do it through your market research. In the game, you have to do it through looking at the different market cards that you face. And when you face different market cards, you find out finally that your apartment One unit of apartment can sell at up to $45,000. Now, if you can sell up to $45,000, you have to find out what am I paying for one apartment today. So what are you paying for one apartment today, Sanjay?
75,000.
Sorry?
75, 75,000.
Are you paying 75,000 for the apartment? No, you have one apartment. How much are you paying?
It's 575,000 for whole apartment.
For the whole apartment? How many units?
24 units, which means 575 divides by 24.
Yes. 575 divided by 24, I think you will get something like 22,500 or something.
23,958.
23,900. So 24,000.
Yeah.
Yes. So
Yes.
your current valuation on this apartment is 24,000. Your best valuation on an apartment is 20,000, because when you get the 60 apartments deal, you will realize that you can buy an apartment for 20,000 units, $20,000. So $24,000 is 4,000 more than the $20,000 that you can make the deal on when it comes from the 60 apartments. But when you want to sell it, you can sell it at $45,000, which means 24 to 45 is $16,000 on every single unit, right? All right, Daniel, it's time for you to leave. Yes, I think this meeting has gone longer than the other meetings.
Yeah,
we should.
I really have to go, guys. So have a nice weekend.
No worries. You too. Enjoy your
You
weekend.
too.
Yeah, bye bye.
Bye.
All right. So we should end up this meeting quite soon, because this is past our official time, and this is probably going to be the longest YouTube video that we would upload. Right. So your asset valuation is going from 24,000 to 45,000. What you stand to gain 16,000 on every unit that you sell if you get the opportunity to sell. That's your best deal, and this is a reasonable deal. So 24,000 is closer to 20,000 than to 45,000. So you have a good space between between your buying price and your potential selling price. So you could actually buy in profit, and you can make capital gains when you are able to sell it. So now do you see, Sanchit?
Yes.
Yes. So what do you feel now? What is your unit cost?
24,000
24,000.
per unit.
Yes.
Per unit.
Per unit. What is your what is the capital gains that you can potentially make on one unit?
Still, I cannot figure out that capital gain.
What is capital gains? I think you are not clear with the concept of capital gains.
Yeah, I'm not pretty clear with that.
All right. Okay. So I think we should not take this any longer. So I will leave that as a homework to you. Okay.
Okay.
So read about capital gains. That yes, Titus. Catch you later. Catch you in the next meeting. We'll see you on the club. It's okay. We are also ending up this meeting very soon. It was nice of you to join us. Welcome again.
Thank you. Thank you very much.
Right, Titus.
All right, guys. See you.
Right. Okay, so
Goodbye.
okay, the title is gone. Let's wind up this meeting and let's keep it for the next time, Sanjit. Next Zoom meeting that we meet, if you can figure out what is capital gains, what is make your own definitions. Make your own definitions about what capital gains is, what valuation means, what cost means, what price means, and this would actually help us to move faster in our financial education, because knowing what these are is quite important when it comes to making the right choices and understanding the conversation that goes on in financial circles. This is very important. If we speak the language, then we are faster to learn. This is the same case even if you are going to school, regular school. If you don't speak the local language, if you're not able to understand uh, what everybody else is speaking in school, then it is very difficult to catch up. But it becomes slower. So if you make the same conversation everywhere, if you participate in the conversation everywhere, then it becomes easier to then you become familiar with the definitions, you become familiar with the you develop the ability to connect the conversation from one opportunity, one occasion to another occasion, and this actually helps. And I think we should leave it there with this week's meeting. This week's meeting, I think I have spoken the most, and we have spoken for almost 2 hours plus. And thankfully, Zoom has not put the time restriction on us, which means I have very less editing to do, which means I can upload the video much faster than before, which is a good thing. So, guys, nice of you to join. If you have questions, I would ask you to stop me anytime. I am very talkative. I keep talking all the time. So this happens a lot.
I have a quick question.
Sure.
Um, will we be playing this game now, or will we end it?
Okay, if you want to continue the game, it's fine. Those of us who want to continue the game, we normally always continue the game after the meeting. And those of us who want to leave, we just leave. But I think if you want to play a game, I think it would be nice if you can start again, because I think Ben will also be joining. Ben has been a spectator. I always ask him to stay away, stay on the sidelines because he plays from the mobile, and it's a little difficult to play around with this. So with the screen share. So without the screen share, he's a great guy to play with. I think you should play the game with him. So it would be nice if you want to restart the game, put Cashflow as play another game, and invite other players also from outside, not just from the club. This game, we put it as a club game because we close it only because we don't want other people to come in, and sometimes that happens. We keep an open game and other people join us, and they will definitely not be able to enjoy the game because we haven't done one payday until now. So we pick up a deal, we discuss about it, we cover topics which are around this deal, and it's not very easy for other people to keep them wait. I mean, if to stay waiting for us to complete the deal. So if you want to continue the deal, if you want to play a game, I think the best thing, if you want to apply, I mean, it would be very nice if you would play the game right after this meeting, because you would be able to apply this analysis, this what you learn right away. And that is one of the best things that the game gives us in terms of opportunity, because you learn something, it gives you a chance to experiment it. It gives you a chance to apply it. And if you learn by applying it, that is the best way to learn. That is what stays with you. That is what becomes your experience. Unfortunately, I will not be able to join the new game. So if somebody would take initiative and start the game, I think, yes, okay, Ben would do that. So Ben would start a game, and you would call it what? Quick fix or cash flow?
Are we having a Zoom meeting on next game? Or we
If
will
you
just
want to start a Zoom meeting on the next game, it's fine. But I will not be joining. I have something else that I have to attend to. I've already eaten into my time for that. But because I'm traveling tomorrow, so I need to prepare for that. So before that, so I will not be joining the Zoom meeting or the game if you start this. But you should go ahead and do it. Ben, what would you want to name the game?
I'll call it cash flow. I'll call it cash flow.
All right, all right. So it's easier for everybody to recognize. So cash flow, and if yeah, it shouldn't be difficult for you to post the link on the cash flow club as well. So if there are other players who want to join from the club, they could also do that. And so let's call this meeting to a close officially. Or is there something else that you want to quickly discuss?
Maybe a quick one. When you're looking at your cash flow,
yes,
from the deal that you get versus your cash that you have, how would you explain looking at that type of calculation? How do you calculate the deal's cash flow versus the cash that you previously had?
All right. See, since this game gives us unlimited borrowing, I really don't look at what is my cash and how do I get cash for making a deal. I normally just go ahead and borrow, and every time, but the only um, condition that I have, the most important condition that restriction that I make is that I need capital gains or I need cash flow of minimum 5% from the deal. If I have a cash flow of 5% or return on investment of 5% from the deal, or if I have a cash flow, or if I have the potential of making capital gains, so I need one of the two kinds of incomes. It could be the cash flow, or it could be the return on investment, or it could be the capital gains. But without one of these, I don't make the investment. This is the only condition that I have. So this way, I know that I'm making the right kind of deals. I'm making deals which are worthy of my cash. I'm making the right investments. Now, once I make my right investments, I don't look at how much cash I have, but since I've already looked at how much cash I can generate, I borrow to cover my payday because I'm totally confident that my assets will definitely create the capital gains that I want to cover my debts if I'm already if I already have a debt. So I normally don't look at my cash before I run. I only look at my cash to make sure that I can cover my cash requirement for the next payday if I am in negative cash flow. This is the only time that I look at my cash. My cash gives me only a confidence to move through the next payday.
That's good. Thanks.
Right, Ben. All right, guys.
So anyone who is able to play, let's.
Yes.
Yeah, I will join.
All right, then we got 4 players, so 2 more from the Cash Club.
Join, right? 1, 2.
All right, then thank you for the today's Zoom. It was nice.
Today's Zoom was mostly me talking. I'm sorry for that. I promise I will try and give more opportunity for others to speak as well.
That's what we're working on, so no worries, man.
Yes. Let's get there. All right, so that's the official close to the meeting, and thank you all for joining. Thank you all for being active participants, active listeners, and active in our financial education.
Great, thank you.
Thank you, guys.
Bye.
See you.
Thank you for joining, people. Bye-bye.
Yeah.